Deere & Company stock ticker DE is down only 2% year to date, which when you compare that to the broader market as a whole during that same amount of time, you can see that is a pretty spectacular return. Combine that with the fact that the company does have a commitment to increasing the amount it pays in dividends with a nice low payout ratio, it's become a more attractive investment opportunity for dividend investors. So in this video, we're going to be jumping into my stock valuation spreadsheet to see if this is a stock we should be buying or selling. And on the spreadsheet, we have our 4 different valuation models. We have Graham's valuation, we have a discounted cash flow model, a multiples valuation, and a dividend discount model. And all 4 of these valuations will roll into our output tab. So let's go ahead and jump over to our stock screener. If you'd like to be able to download the spreadsheet, then you can head over to my Patreon page at the link in the description. But okay, so the first thing we'll come up here and do is we'll come in and plug in our stock ticker and hit enter, and you can see all of this data is going to automatically load in. We're currently looking at a 365-day chart. Let's just go ahead and zoom out a little bit more and look at a 750-day chart. So I'll hit enter, and you can see a huge run up in the stock price, a little bit of a decline over the past year. Come over here and look at dividend data. You can see they're paying out $4.52 per share, which gives it a dividend yield of 1.32% and a nice low payout ratio of just 20.2%. If we come over here and look at the moving averages, we can see up pretty large over the past 20 days, 8.39%, 50-day moving average 5.89%, and the 200-day moving average down about 5%, currently trading at a price of $343 per share. 2-year return really solid at 89.4% and slightly down over the past year. They obviously are in the industrials industry, and you can see analysts currently have a price target of $384 per share. Fairly high institutional ownership at 72.10% and a beta slightly above 1, so you are going to see a little bit of volatility with this company. But let's go ahead and jump into our first valuation, which is going to be Graham's valuation. Now, this is a valuation model invented by Benjamin Graham himself, who is one of Warren Buffett's mentors, and he wrote the greatest investing book of all time, The Intelligent Investor. And this is the formula he laid out for us to calculate intrinsic value. So we're going to go ahead and plug these numbers in. And the first thing we need is our earnings per share. Now, DE has really strong earnings per share, as you can see right here at 19.17. We then multiply that by the price to earnings of a company with no growth, which is 7. And then we apply our growth rate projection, which I pulled from analysts, industry expectations, and company expectations. So I'm applying a growth rate of about 12. We then multiply that by 4.4, which is the average yield of AAA corporate bonds. Take that number and divide it by Y, which is the current yield of AAA corporate bonds. Put all of this together and we can see we come to an intrinsic value of $400 per share. So much higher than the current trading price. But let's go ahead and jump over to our discounted cash flow model now. And this is one of the most popular ways to value a company. Essentially, the idea behind our discounted cash flow models, we should be able to value a company based on how much future free cash flow they are going to produce for the rest of all time. So what we're going to do is we're going to apply a growth rate to the future free cash flows of the company. And in order to do that, we're going to plug in the historical free cash flows for the company. This is going to allow us to see the year-over-year growth rate for each of these years. We can see pretty high growth rate over the past few years at about 26.55%. It obviously won't be that high moving forward. When you look at industry expectations, analyst expectations, I think a growth rate of 9% is going to be a little more accurate. Let me go ahead and fix that right here. So I applied that growth rate to the future free cash flows of the company and applied it to the terminal value, which is the sum of all the future free cash flows past the year 2030. I then took the present value of all of these future free cash flows and added them together right here. I added the company's cash and cash equivalents and subtracted out their total debt to find their equity value. Once I had the equity value, I just divided by the number of shares outstanding to come to a discounted cash flow price per share of $559. But let's go ahead and jump over to our multiples valuation now. And the idea behind our multiples valuation is using a multiple like price to earnings. We should be able to look at other companies in similar industries and similar in structure to our company we're trying to value and see how the market is valuing them. So we're taking companies like you can see right here, like Caterpillar, for example. We're taking their stock price, dividing it by their earnings per share to get the price to earnings multiple. So we do that for a few companies. We then take the average price to earnings multiple and multiply it by DE's earnings per share to find their intrinsic value according to the multiples valuation. As we can see here, it is leading to a lower valuation. We can see the average price to earnings of companies that are competitors of them right at about 13. If we jump back over to our stock screener, we can see the price to earnings for DE currently almost at 18, so they are trading at a much higher price to earnings multiple. But let's go ahead and look at our last valuation model, which is going to be our dividend discount model. And this is obviously a pretty important model for a few different reasons. A lot of people are interested in investing in companies like this solely for the dividend growth. So let's go ahead and look at it. But the idea behind this model is we should be able to value a company based on how much they pay out in dividends and how much that dividend is growing. So what I've done is I've plugged in the quarterly dividend payouts over the past few years so we can see exactly how much they pay out each year. And this allows us to see the year-over-year growth for their dividends. So we can see right here, there was a year where we didn't see any dividend growth. That's never a good sign. We typically like to see management have a large commitment to increasing the amount they pay in dividends year over year. So that is a little bit of a red flag. But if we look at these other years, we can see really large increases in the amount they paid in dividends, a huge jump up right here at 25%. So when we take the average growth rate of these past few years, we can see it was at about 13.53%. It likely will not stay that high moving forward. I'm projecting a growth rate of about 7.25%, which is still pretty fairly high when you consider that's projecting it out for the entire future of the company. After applying a discount rate of 9%, we can see I came to a dividend discount model price per share of $277. But let's go ahead and jump over to our output tab. And here on the output tab, we're going to be able to see all four of our valuation models. Grams at $400 per share, multiples at 251, discounted cash flow at 559, and dividend discount model at 277. When we average all four of these together, we can see we came to an intrinsic value of $372 per share, which is a little bit above the current trading price for this company. Now, as a value dividend investor, I always apply a margin of safety to my investment. So let's say I'm a fairly aggressive investor and I only apply a 10% margin of safety. I'll hit enter. We can see based off of this, the acceptable buy price for this company is $334 per share, which is slightly below the current price, so it's not currently a buy. Let's go ahead and say that I'm more conservative with my investments and I apply a 30% margin of safety. We can see in that scenario, the acceptable buy price for this company is about $260 per share. So it's still not a stock we should be buying. So as we can see here, current trading price is a little bit below the intrinsic value. For me personally, I would like to be able to apply a little bit more of a margin of safety so I can feel comfortable in this investment. I really like the recent dividend growth other than the 1 year where they did not increase the amount they paid in dividends. So as for me, this is probably going to be a stock on my watch list. If it does fall down within my margin of safety, I might pick up shares in the future, but as for now, I'm just going to leave it on my watch list. But go ahead and let me know what you guys think of this company in the comments down below, if you plan on buying or if you plan on selling. If you'd like to be able to download the spreadsheet, then you can head over to my Patreon page at the link in the description. So that being said, thank you guys so much for watching this video, and please don't forget to like and subscribe to the channel.